All right, let's talk about a company that, is probably sitting right there in your digital wallet, PayPal. We're going to really dig into the numbers today and see what the story is behind its stock.
I mean, everyone knows PayPal, right? It's a total powerhouse in digital payments. But here's the thing, the stock has really taken a tumble from its peak. And that makes you wonder, could it be a hidden bargain right now? Well, that's exactly what we're here to find out.
So here's the game plan. First, we'll get a quick snapshot of what PayPal is all about. Then, we're going to check its financial vital signs before trying to calculate its true value. After we get our verdict, we'll double-check our work by looking at the company's books. And finally, we'll wrap it all up with the key takeaway. Sound good? Let's get into it.
Okay, first things first. You can't really value a company until you understand what it actually does. So let's get a nice, clear picture of the business behind that PYPL stock ticker.
So what is PayPal really? Well, at its core, it's this giant tech platform that makes digital payments happen for millions and millions of people and businesses all over the world. It's technically in the consumer cyclical sector, and you've definitely heard of its brands. I'm talking PayPal, of course, but also Venmo, Braintree, and Zoom. You can think of them as this huge network that connects buyers and sellers in the digital world.
All right, so we get the business. Now let's look at the numbers that actually power it. What we're looking for here are the vital signs. Signs of a strong, profitable, and growing company. We need to know if that financial foundation is solid.
And first up, just look at the size of this thing. We're talking a market cap of almost $66 billion. So yeah, this is no small startup. PayPal is a huge, established player in the global financial system. That number alone tells you a lot about its scale and just how important it is in the market.
And it's not just about valuation. It's about the business they're doing. The company is pulling in over $32 billion in total revenue. That's the top line, the big number that shows you just how much money is actually flowing through their payment systems. That's massive.
Whoa, now this is an impressive number. A 19.4% jump in earnings year over year. That's a really strong signal. It tells us that PayPal isn't just making money, it's getting better and better at it. It's becoming more profitable over time. And that, right there, is a key sign of a healthy business.
Okay, let's look at this financial dashboard. It gives us a much deeper look. These metrics, they help us figure out two things: how the market values the stock and how well the company is actually running. Now, if you look at the PE ratios, they seem kind of modest, right? For a big tech name like this, that might mean the market is a little worried about future growth. But then, you look at that nearly 15% net profit margin and an almost 23% return on equity, wow, those are the numbers that scream very healthy, very profitable business.
Okay, so the vital signs look pretty good, right? But what is PayPal really worth? I'm not talking about today's stock price. I'm talking about its deep down, fundamental, intrinsic value. And to figure that out, we're going to pull out one of the most trusted tools in the financial toolbox, the discounted cash flow model.
So what on earth is intrinsic value? Well, think of it this way. Imagine you're buying an apple orchard. You wouldn't just pay for the apples you see on the trees right now, would you? No. You'd try to figure out the value of all the apples that orchard is going to produce for years to come. That's exactly what intrinsic value is for a company. We're estimating its worth based on all the cash we think it can generate from today into the future.
Now, to make this model work, we have to plug in a few key assumptions. You're seeing numbers here like the risk-free rate and something called the weighted average cost of capital, or WACC. These are just the core inputs. That WACC, for instance, is basically the average return the company has to pay its investors. It's super important because it helps us factor in the risk when we're trying to predict PayPal's future cash. And here we go. These are the results from our model. Now, obviously, nobody can predict the future perfectly, so we've calculated a range of outcomes. In a worst-case scenario, if growth slows down, we think the value is around $72. In a best-case scenario, it could be closer to $111. But our base case, the one we think is most likely based on our assumptions, lands right at $92.21 per share.
All right, this is the moment of truth. We've done all the math. We have our estimated value. Now let's see how that number compares to what the stock is actually selling for in the real world.
So, the big question is, we have our number, that $92.21. How does that compare to the stock's actual price on the market today?
And here it is, side by side. Our calculation, our base case, says the stock should be worth about $92, but the market is currently pricing it at just under $69. That's a pretty big difference between our calculated value and the actual price, right?
So the conclusion from our model is really clear. Based on this whole DCF analysis, the data is pointing to one thing. PayPal stock looks undervalued right now.
But wait, a model is just a model, right? It's only as good as the assumptions we put into it. So let's kind of stress test our conclusion here. Do the company's own financial reports back this up? Let's take a quick peek at their official books and see if the story holds.
Okay, looking at their income statement, you see a really clear trend. Revenue is steady and it's growing. That's the engine of the company. When you have consistent growth in revenue and profit, that provides a really strong foundation for the future cash flows we were just talking about. So yep, so far, this checks out.
Next up, the balance sheet. This is basically a snapshot of what the company owns versus what it owes. And the key thing to notice here is the common stock equity. It's strong and it's been growing. That tells us the company's net worth is actually increasing, which means they're building a more solid financial foundation every single year. And last but not least, the cash flow statement. This one is super important for what we're doing. Just look at that strong, positive free cash flow. This number, it's the cash that's left over after they've paid all the bills and invested back into the business. It's literally the lifeblood of a company, and it's the main ingredient for our valuation model. Seeing a healthy free cash flow like this, it definitely backs up what we found.
Phew, okay, we've looked at the business, the key metrics, our own valuation, and we even checked the company's books. So let's boil all of this down into one simple takeaway.
So here's the bottom line. We've got PayPal, a huge, profitable company that's showing solid growth. Our main valuation tool, that DCF model, came up with an intrinsic value of around $92 a share, and when you put that right next to its current market price of about $69, well, there seems to be a pretty big disconnect. All this data seems to suggest the stock is undervalued.
And that's our deep dive. The numbers seem to paint a really compelling picture of a financial giant that might be undervalued. The big question now is, what's the next chapter for PayPal? And maybe more importantly, will the market eventually agree with the numbers? I guess we'll just have to wait and see.